Okay, so just to give you a bit of background on Glennon Capital. So I set the business up in 2008, and we invest in small, micro and mid caps, and that's all we do. And we've had a long association with HUB24. We've been on the platform since 2011. We try to be long-term investors, so the portfolio's got quite low turnover, and we've held stocks for many years, which means you've really got to get it right when you're looking for those investments. So some of the things that we look for is quality, and to define what quality is, I'll go through some of the things that we look at. So, and I'll go into detail on some of these attributes a little bit later, but the key thing for us is management, having superior management, because in small caps you don't have multi-stream businesses, so it's not like a BHP or a National Australia Bank that's got many, many businesses inside of it. They're quite binary. Sometimes you might just have one product or one division. If something goes wrong, the business can go broke. So making sure you've got good management there is crucial when there's such high-risk businesses. The other thing we like to make sure that we've got is growth. So whether that be a market that's growing or a company that's growing its market share within an industry, or if the industry is not growing, that they're growing their revenue or their margins, which is an important thing to make sure you're not investing in businesses that are going backwards or not sustainable long term. So the other thing I've mentioned is sustainable business. We try not to invest in businesses that we think are going to be a fad, that are not going to be around in a couple of years. And you know, when I'm talking about that, I guess, you know, a lot of people will be familiar with, you know, one of the greatest fads of the last 10 years, you know, the power balance band. It was something that everyone bought, didn't do anything, and was gone very, very quickly. So we like to be in businesses we think will be around for a long time, that have got a good long-term product, not something that has got a 2 or 3 year life cycle and then the whole company has to reinvent itself. We also like to invest in companies that are in industries that have got barriers to entry, so not everyone can go and open. So it'd be rare that we'd be buying into a coffee shop business, for example, because everyone can go and open a coffee shop. There's very little capital required. There's no regulatory requirement to get a license to open a coffee shop. So we like there to be some level of restriction to new entrants coming into the market. And finally, amongst all of that, we need to see that the business is undervalued. So we need to be thinking that we're, you know, paying 50 cents for a dollar's worth of value. So how we do all of that, we spend a huge amount of time out there meeting with the management of companies to really assess what that management's like, what their track record's like. We've got a big process about generating ideas within the business. And so of all of the companies we go and see, so last month we saw 60 companies. We aim to see, you know, between 400 and 500 companies a year, so we're travelling a lot. We've got a lot of companies coming in to visit us. And of the companies we see, most of that's not driven by companies calling us and wanting to see us or other companies doing capital raising. We really try and focus on our own idea generation, so looking through announcements and different things like that, coming up with ideas, doing some research and going and seeing the management. Of the meetings that we have, 63% of those are one-on-one meetings, so we're not attending conferences and seeing, you know, 30 companies in a couple of days. It's mainly driven by our own activities, going out, hitting the road, travelling around, seeing companies, seeing their operations, making sure that we're buying a real tangible business that's there and we're seeing the people and, you know, it's not a sham. And it may sound funny, but, you know, I've seen it over the time I've been in the market, businesses that aren't real businesses or, you know, there's fraud involved, and there's a couple of cases of that at the moment. And generally when we're out there, we're seeing the managing director or the CEO of the business. So there's a list of some of the companies. Some of you may or may not have heard some of those things, but you know, in the last month we saw Synlait Milk, an unlisted company, Stealth Technologies, Metgasco, Southern Cross Electrical, Titomic, Vita Group, Pioneer Credit, and Vera. So there's some of the types of businesses. Most of you probably haven't heard of a lot of those businesses. And then to make sure, you know, on this theme about quality, what we're trying to do is back up our research by not only talking to the managing director and senior management companies, but going out there and, you know, talking to clients of companies, other listed competitors who are in the same space, unlisted companies, salespeople, looking at companies' websites, looking at their competitive websites. Because the whole thing about this area of microcaps is very under-researched. There's not a lot of information. A huge amount of it's not covered by brokers. So you really need to make a conscious effort to go out there and get as much information. So continually seeking information on your investments, what's happening in the marketplace, where there's regulatory changes, where the competitors have got new products, and keeping up to speed, because the businesses are so binary. As I said earlier, maybe one product And if someone launches a competing product that's better, it can be very detrimental to that investment that you've got. So just to really reiterate on and spend a bit of time on management as the first of those key quality items that we look at. Having, you know, we call it superior management, people that have got a track record of success, and quite often people will back themselves. So we call that skin in the game, making sure that it's not other people's money that they're playing with. They put their own wealth into that business. They have shares in the company that they're operating, and they're very driven long-term about making the right strategic decisions for the business that will increase their wealth and simultaneously our wealth as shareholders invested alongside them. So it's a very hard thing to do when you first meet management. Sometimes we'll meet them. Sometimes it takes us 4 or 5 years to make an investment, watching how that company's gone, waiting for the right time to buy the business when the valuation's right, and continually assessing that management's what they say they're going to do and how they actually do that. And there's many management out there that, you know, crash and burn or make short-term decisions to benefit their own remuneration if they're remunerated for short-term gains. We like to make sure it's a long-term alignment of interest, and that's where having skin in the game is something that we are very strong about looking at when the companies we invest in. I mentioned growth prospects earlier, but very important to make sure key characteristics of small caps is that you want share price to go up. Generally, that happens when the company starts increasing their revenue or making more profit. The easiest way for that to happen is for them to be growing their market share, taking share off competitors, expanding the market that they're in, or increasing their margins and having that pricing power that they can actually put their prices up. You don't want to be invested in a company where every year their clients are out there saying to them, look, you're going to have to drop your prices. So, for example, companies that supply the automotive industry, every year you hear the term cost downs. Every year they've got to start selling more and more of the same product because their margins are decreasing. So we don't think that's a great quality business, and we try to avoid companies like that. You know, I mentioned the power balance band, but sustainable businesses, a company that we can see will be around for 5 or 10 years in the current shape that it's in. So having good products, they've got good positions in their market, not things. We try to avoid fashion businesses. For example, one year, you know, there's been many, many examples. Billabong's had, you know, checkered history in terms of launching products, getting fads wrong, you know, as their demographic, the people that buy their product changes. You know, some of the guys in the office, their kids now won't wear Billabong because, you know, the parents were wearing Billabong when they were younger. So you don't want to be in a business that has to keep reinventing itself, or a business where technology, for example, is changing that industry. So we try and be a beneficiary of changes in technology, where we see there'll be a permanent shift in the market. You know, people taking market share away from banks, for example, small financing companies, where we think that's a new paradigm, and there will be shifts in technology that will take market share from older companies that don't reinvent themselves because their business is less sustainable. I mentioned barriers to entry. It's something that we like, so regulated industries. So, for example, one of the businesses in the portfolio that we own is National Vet Care. You know, there are barriers to entry there. You have to be a vet, obviously, to own a veterinary practice. So there's a barrier. So they're the types of barriers to entry that we look for. You know, telco is another example. You know, you need licenses to be able to sell telecommunications. So they're the types of barriers that we look for. There's varying degrees of barriers in the businesses that we buy, but it's nice when you can have some sort of structural barriers, with the caveat that you don't want your barrier to be government regulation, where you think there might be a change in government regulation and that'll change your business model. And finally, once it's met all those criteria or a combination of those things, we like the business to be undervalued. And there's a range of metrics that we use to try and look at whether a business is undervalued. One of those being a DCF valuation, where we try and project out the cash flows, because what's most important to us is the cash that's coming into the business. And we want to make sure, in the simplest terms, that we think that there's a dollar's worth of value and we're paying 50 cents for that business. But the DCF is not the only metrics that we use. We'll also use some of the parts valuations, where we'll look at a business, look at the components or the different divisions in a business, value each of those, and say, you know, is that more or less than the current share price? And there's many, many businesses that we keep on a watch list that just aren't trading at the right price. And because we're long-term investors, we can wait 3, 4, 5 years for something to happen and that share all of a sudden to look attractive, and then we'll pick it up, because it's all about where you buy and where you sell. So, you know, when there's weakness in the market, there's short-term noise. If you've got a valuation on the business and you're confident of what's inside the business, it gives you opportunities to acquire those shares at lower levels and make a decent return.